2023, Fidelity ran an internal analysis of its best performing retirement accounts. The top performers shared one thing in common. They weren't the accounts with the highest contributions. They were accounts whose owners had either forgotten about them or died. No active management, no timing the market, just money sitting there, untouched for decades. Most people look at that and think the lesson is patience. It isn't. The lesson is that the biggest threat to long-term investing isn't market volatility. It's the investor. So here's the question that actually matters. If the amount is almost irrelevant and the strategy is almost irrelevant, what exactly determines whether someone ends up with $600,000 or almost nothing? That gap between people who started small and stayed consistent versus people who waited for the right moment is what this video is about. Because every year you spend waiting is a year compounding doesn't work for you. And compounding, unlike income or savings rate, doesn't give you those years back. My name is Alex, and if you've ever looked at your budget and thought $100 a month couldn't possibly move the needle, keep watching, because the math on this is genuinely counterintuitive, and I'm going to show you exactly how the compounding curve actually behaves across 40 years and where the real growth is hiding inside that timeline. Once you understand how the numbers actually stack, you'll stop waiting for the right amount and start seeing time itself as the asset you're either buying or wasting. And that realization starts with a trap almost everyone falls into. Here's something worth sitting with for a moment. In a survey conducted this year, 54% of Americans said they had financial regrets from last year that they wanted to fix. Not 54% of people who made obviously bad decisions. 54% of people who, by most measures, were doing everything right. They had jobs, they had budgets, they had good intentions. And still, looking back, they felt behind. That feeling has a specific cause. And it isn't what most people think it is. Take someone like a 36-year-old project manager in Denver. Solid income, around $78,000 a year, responsible for money, pays his bills on time, avoids unnecessary debt, and puts a little aside when he can. But every time the idea of investing comes up, the same thought follows. $100 a month isn't going to do anything. Not at this level. Not against the kind of wealth he's trying to build. Better to wait. Wait for the raise that's coming. Wait until the car is paid off. Wait until things feel a little more stable. Then he'll do it properly with a real amount. Something that actually moves the needle. That logic feels reasonable. It isn't. No bell rings when conditions are ideal. No signal that says now is the perfect time. The raise arrives and something else takes its place. The car gets paid off, and the next expense fills the gap. The waiting doesn't end because the conditions change. It ends only when the habit changes. And here's the uncomfortable part. Every month spent waiting is a month that compounding doesn't run. Compounding doesn't offer refunds on lost time. Now you're probably thinking that $100 genuinely is too small to matter. And on the surface, that seems right. The average American currently saves just 3.6% of their disposable income, which on a $78,000 salary works out to roughly $230 a month. 100 of that feels like it disappears without a trace. A dinner out, a couple of streaming subscriptions, something you ordered online and forgot about. It's the kind of money that evaporates on a slow weekend without requiring a single conscious decision. But that's exactly what makes it powerful. Not despite its size. Because of it, the $100 you won't miss is also the $100 you won't touch. You won't panic and pull it out when the market drops 8% in a week. You won't second-guess the timing. You won't convince yourself to pause the transfer just this month because something came up. Small enough to set and forget is also small enough to leave alone. And leaving it alone, it turns out, is most of the work. The math on this is genuinely counterintuitive. Someone who starts investing $100 a month at 30 years old will, in nearly every realistic historical scenario, end up with more than someone who waits until 35 to invest $300 a month. The person waiting for the better number, who delays 5 years to triple their contribution, still loses. They lose because the first 5 years aren't just 5 years. In a compounding system, the earliest years are the most valuable years. The market doesn't weigh time equally. The first decade does more work than the last two combined. The project manager in Denver doesn't need a bigger number. He needs to stop waiting for one. And what makes that so hard to accept is that the first few years of investing $100 a month look absolutely nothing like the result. The silent foundation you're building in years 1 through 3 is almost deliberately unimpressive, which is exactly where we need to start. Most people think investing is about picking the right thing. It isn't. It's about doing something almost nobody actually does. Nothing. That's where the silent foundation pays off. You've spent the first 3 years building the habit, watching an account that looks underwhelming, training yourself not to react. And now the machine you built is about to start doing something you didn't fully expect. But before we get to the numbers, it's worth understanding what's actually happening inside the account. Most people, when they hear the word compounding, nod along as if they understand it and then go back to thinking about it the wrong way. Here's how it actually works. Imagine you put $100 into an account that earns 10% a year. After year 1, you have $110. Fine. But in year 2, the 10% doesn't apply to your original $100. It applies to 110. So you earn $11 instead of 10. That extra dollar looks meaningless. It isn't, because in year 3 you earn interest on that extra dollar too, and the year after that. And every year for as long as the money sits there untouched, the growth isn't adding, it's multiplying. And the longer it runs, the faster the multiplication gets. The S&P 500, that's the index tracking 500 of the largest publicly traded companies in the United States, has returned an average of roughly 10% annually over the last 100 years. Some years it returns 25%. Some years it drops 20%. But zoom out far enough and the average holds. That average is the engine your $100 a month is plugged into. Now, the practical question is how you actually set this up. And here's where it gets simpler than most people expect. You open a brokerage account, Fidelity, Schwab, Vanguard. It doesn't matter much. You pick a broad, low-cost index fund that tracks the S&P 500. Currently, the best of these charge somewhere between 0.03 and 0.2% per year in fees. On a $100 monthly contribution, that's essentially nothing. You set up an automatic monthly transfer so the money moves on its own, without requiring a decision from you, and then you leave it alone. That last part is the hard part. Not intellectually, everyone agrees with it in theory. But in practice, when the market drops 15% in a month, and every financial headline is predicting disaster, the urge to do something is almost overwhelming. This is where most investors quietly blow it. They don't make one catastrophic mistake. They make a dozen small emotional ones. They pause the transfer just for now. They sell when things feel scary. They wait to buy back in until the market feels safe again, which is always after it's already recovered. Think about a 32-year-old nurse in Atlanta investing $100 a month automatically. The market drops sharply one spring, the way it has many times before. Her balance falls from around $4,000 to just under $3,000. Nothing in her account suggests she should stay calm. But her automatic transfer doesn't know that. It fires on the 15th of the month, the same as it always does. And at $3,000, that 100 buys more shares than it did at 4,000. When the market recovers, and historically it always has, she owns more of it than she would have if she'd paused. That's dollar cost averaging, not a strategy you implement consciously, a structural feature of showing up every month regardless of conditions. You buy more when prices are low, less when they're high, without ever having to decide which is which. The discipline is baked into the automation. For investors receiving regular income, dollar cost averaging isn't really a choice. It's a structural reality. Your $100 moves on the same date every month. The market does whatever it does. The two things happen independently of each other. And that independence is the protection. Here's what this looks like in the numbers. $100 a month at a 10% average annual return. After 1 year, you've put in $1,200. Your balance is roughly $1,263. The gap is $63. Unimpressive. After 2 years, you've contributed $2,400. Your balance is around $2,730. The gap is now $330. After 3 years, you've contributed $3,600. leaving a balance of around $4,230. The gap is $630. You see what's happening. The gap isn't staying flat. It's growing. Every year, the interest earns its own interest, and the pile gets slightly less dependent on your monthly contribution and slightly more dependent on its own momentum. That momentum doesn't announce itself. It builds quietly, invisibly, until one day the numbers stop looking like something you're building and start looking like something that's building itself. That's the tipping point, and it arrives sooner than most people realize. Nobody tells you about the moment the math changes. It doesn't come with a notification. There's no threshold your app crosses that sends you an alert. You just check your balance one day around year 4 or 5 and realize something quiet has shifted. The number is growing faster than your contributions can explain. And for the first time, the account feels less like something you're feeding and more like something that's feeding itself. This is the tipping point, and understanding what's actually happening here is worth slowing down for. Remember where you were after 3 years. You contributed $3,600 of your own money, and your balance sat around $4,230. The gap between what you put in and what you had was $630. Meaningful, but modest. Now watch what happens as you push through years 4 and 5. At the end of year 4, you've contributed $4,800. Your balance is now around $5,850. The gap has grown to just over $1,050. Then year 5, $5,400 contributed. Balance around $7,600. The gap is now $2,200. That's more than 3 times what the gap was just 2 years earlier. Your contributions haven't changed. The monthly transfer is still the same $100. It's always been. But the return isn't just landing on your contributions anymore. It's landing on everything. Contributions plus previous returns plus the returns on those returns. The base keeps expanding, and 10% of a larger base is a larger number every single year. By year 5, your money has quietly hired a second employee. That employee doesn't take vacation days, doesn't call in sick, puts in the same hours in a down market as in an up market, and crucially, that employee earns returns that go straight back into the account, where they immediately start earning returns of their own. Here's how this looks by year 10. You've contributed $12,000 total, $100 a month for 120 months. Your balance, at a 10% average annual return, sits at around $20,500. The gap between what you put in and what you have is $8,500. $8,500 generated entirely without your involvement, without a second job, without a side hustle, without a single additional decision, just time and the structure you set up years earlier. Now consider what that gap means in real terms. $8,500 is roughly 4 months of rent in the median American city right now. It's a used car, paid in full. It's the kind of money that would take the average person several months to save from scratch, and it appeared in your account because you didn't touch the one you already had. This is also where the behavioral risk peaks, because around years 4 through 7, something uncomfortable tends to happen. The account is large enough to feel real, but not large enough to feel untouchable. A Dalbar research study found that over the 20-year period ending December 2024, the average U.S. equity investor returned 9.24% per year, compared to the S&P 500's 10.35%. That gap doesn't sound dramatic, but run it forward. A $100,000 investment left untouched in the S&P 500 for those 20 years grew to approximately $717,000. The same amount, subjected to the average investor's buy and sell behavior, ended at roughly $345,000. Not because those investors picked bad funds, because they kept making small emotional decisions, pausing contributions, moving to cash, waiting to buy back in after the recovery was already well underway. Think about a 40-year-old electrician in Cincinnati who's been investing $100 a month since he was 30. His balance around year 7 dips noticeably during a rough quarter. Nothing catastrophic, just an uncomfortable stretch where his account reads lower than it did 6 months ago. He pauses the transfer. Just for a couple of months, he tells himself, until things settle. 2 months become 5. He misses the sharpest part of the recovery. He restarts eventually, but those 5 months represent contributions that didn't go in during discounted prices and returns that didn't compound forward. The cost isn't visible on any statement. It just quietly subtracts from what the account would have been. From 1996 to 2025, investors who missed just the 10 best trading days saw their total portfolio returns fall by about 56%, according to an analysis from Hartford Funds. 10 days, over 30 years. More than half the return is gone. The market doesn't telegraph which days those will be. They tend to cluster right after the worst stretches, which is precisely when most people are sitting on the sidelines, waiting for things to feel safer. Staying in is the strategy. Not because staying in is always comfortable, but because the discomfort of staying in is far cheaper than the cost of getting out. By year 10, with $20,500 in the account and the compounding engine running at full speed, you're no longer just an investor. You're a passenger in a vehicle that's picking up speed on a long downhill slope, and the slope gets steeper from here, which is exactly what the identity shift of year 20 and beyond is about. At some point in a long-running investment account, the math stops being linear. It doesn't warn you when this happens. There's no clean milestone, no anniversary notification. But around year 20, the numbers start behaving differently. And if you're watching closely, you realize the game has quietly changed. Pick up from where year 10 left off. You had $20,500 in the account. Your monthly transfer is still the same $100 it's always been. But now watch what happens to the gap, the difference between what you actually contributed and what the account holds, as you push into the second decade. By year 15, you've put in $18,000 of your own money total. Your balance sits around $40,800. The gap is now $22,800. More than double what you contributed has come from the market itself. Then the year 20 arrives. $24,000 contributed across 2 decades of $100 monthly transfers. Your balance? Roughly $76,000. The gap is $52,000. $52,000 generated by an account that's running almost entirely on its own momentum. Let that sit for a second. $52,000 is more than the median American worker earns in an entire year right now. It appeared in your account not because you worked harder, not because you picked the right stocks, not because you timed anything correctly. It appeared because you left the structure alone and let time do the arithmetic. And here's the part nobody talks about at year 20. The account is now generating roughly $7,000 annually in returns entirely on its own, not from your contribution, not from any action on your part, just from the size of what's already there, compounding at its historical rate. $7,000 is money that appears without a shift being picked up, without a side project, without a promotion. It just shows up, and next year it's slightly more, and the year after that slightly more again. This is where the identity shift begins, not in the account statement, in how you start thinking about the money. Consider a 44-year-old high school teacher in Raleigh who started investing $100 a month at 24. She didn't do anything sophisticated. No individual stocks, no sector bets, no timing the market around economic cycles. Just the same automated transfer into a broad index fund, month after month for 20 years. She never increased the amount. Life didn't always allow for that. But she also never stopped. Not during the years when the market dropped. Not during the stretch where her balance seemed to stall for 18 months. Not during the rough patch when canceling felt like the rational thing to do. At 44, her account has a balance she genuinely didn't expect. And something has shifted in how she carries herself financially. The anxiety that used to trail most money decisions has quieted. Not because she's rich, she isn't, not by conventional measures, but because she has a number that is growing without her involvement. That changes the math on everything else. It changes how she thinks about her job, about risk, about what she's willing to say no to. The account gave her something harder to quantify than a balance. It gave her options. Currently, the median American aged 45 to 54 has roughly $87,000, saved against a retirement benchmark of $450,000 on a $75,000 salary. That gap is significant, but what it really reveals is how much of a structural advantage belongs to the person who started early with a small amount versus the person who intended to start big and never quite did. Now fast forward to year 40. 480 months of the same $100. Total contributions, $48,000. At a 10% historical average annual return, the balance sits at around $637,000. The gap between what you put in and what you have is $589,000. $589,000 that came entirely from time, not from extra income, not from financial sophistication, not from luck, just from the decision you made in your 20s to automate something small and then leave it alone. Put it in human terms. $48,000 is what most Americans take 2 to 3 years to save when they're actively trying. The other $589,000 required no saving at all. It required only patience, which is a different thing. Saving requires discipline against spending. Patience just requires not interfering with a process that's already running. That number, $637,000, gets talked about as the headline. But the real story is what it represents in terms of time purchased. At a standard 4% withdrawal rate, that's the rule of thumb for making a portfolio last through a long retirement. $637,000 generates roughly $25,400 per year without ever touching the principal. That's not total independence for most people. But it's the difference between working because you want to and working because you have no other option. That distinction is worth more than the dollar figure attached to it. Small and consistent doesn't just beat large and eventual in the math. It beats it in psychology too. The person who waited for the right moment, the right amount, the right conditions, they usually arrive at 50 with a collection of good intentions and a savings account that reflects how hard it is to start over. The person who started with $100 a month at 25, who never once had a dramatic investment story to tell at a dinner party, arrives at the same age with an account quietly working in the background and a relationship with money that looks completely different. That relationship, with discipline, with patience, with the long game, is what the next and final part of this story is really about. There's a number from a Northwestern Mutual study released this year that stopped me cold. The share of Americans who describe themselves as disciplined financial planners has climbed to 53% currently, recovering from a record low of 45% in 2024. That's the good news. Here's the other number from the same report. 39% of Americans are currently investing in or actively considering high-risk speculative assets, prediction markets, sports betting platforms, cryptocurrency, because they feel financially behind and believe these assets offer a faster path to their goals than traditional methods. Read that again. People who feel behind aren't turning to compounding, they're turning to gambling. And the reason that matters for this story is what it reveals about what the $100 monthly investor actually built that has nothing to do with the balance. Because the person who spent 20 or 30 years showing up with $100 a month, never dramatically, never heroically, didn't just accumulate money. They accumulated a specific relationship with how wealth actually works. And that relationship, it turns out, is the rarest thing in American financial life right now. Think about two people who both started working at 25. Same income, same city, same cost of living. One of them set up the automated monthly transfer and left it alone. The other kept meaning to start, waiting for a better moment, a cleaner budget, a clearer sense of what to do. By 40, the first person has an account approaching 6 figures that runs itself. The second person has good intentions, mounting anxiety, and a growing sense that the gap is now too large to close through ordinary means. So they start chasing crypto, a hot stock tip, something that can close the distance fast. Among Americans pursuing speculative assets, 73% say they are doing it because they feel financially behind and believe speculation offers a faster path to their goals. 73%. That's not a fringe behavior. That's a majority of people who entered the speculative market, not from confidence, but from desperation. And the thing that put them there, in most cases, wasn't a catastrophic financial event. It was just the years that passed while they waited for the right moment to start something boring and consistent. The identity the $100 investor builds over time isn't the identity of someone who got lucky or picked the right fund at the right moment. It's the identity of someone who learned, really learned, at the level of lived experience, that showing up consistently beats arriving dramatically. Every correction the market threw at them, and they didn't react to. Every month they transferred the money without checking whether the timing was right. Every year they watched the balance grow in a way that had nothing to do with their decisions. All of that compounds too. Not in the account, in the person. Currently, 88% of Americans report feeling some form of financial stress heading into this year, and 77% say they experienced a financial setback in 2025. Those numbers are real, and they're not being dismissive of them. But inside those numbers is a quieter truth. Financial stress, for most people, isn't caused by a single catastrophic event. It's caused by the slow accumulation of small delayed decisions. The month that was never quite the right month to start. The raise that arrived and got absorbed. The intention that stayed an intention. The $100 investor didn't escape financial pressure. They just built a small, automated buffer against it that grew quietly while the rest of life happened around it. And over time, that buffer changed what felt possible. Not because the number was large enough to solve every problem, but because it was real. It existed. It was working. And something about having a financial process running in the background, something you set up and leave alone, changes your posture toward money in ways that are hard to fully explain until you've felt it. Small and consistent doesn't just beat large and eventual in the math. It beats it in the person you become on the way there. That's the whole mechanism. And understanding it fully, what to do with it, what to watch for, and where this naturally leads next, is exactly where the conclusion lands. Here's what this whole journey actually comes down to. The math was never the hard part. The hard part was believing that something small and automatic and deliberately boring could outperform everything louder and faster and more exciting. It can. It does. Consistently. A few things are worth carrying forward. Time is the asset. Not income, not timing, not expertise. Time. The earliest years of a compounding account do more work than the last 2 decades combined. Starting small beats starting late every single time. Automation removes the decision, and removing the decision removes the emotion. And the investor who does nothing during a downturn quietly beats the investor who does something smart. Now think about your own situation. Where is your transfer set up, and when did you last think about stopping it? If it doesn't exist yet, what is the specific thing you're waiting for? There's a related question this raises that this video didn't fully answer. If $100 a month builds this kind of outcome, what happens when you increase that amount? Not dramatically, just gradually. As your income grows, what does the curve look like then? The answer is worth understanding, and it changes the picture considerably.